Hello, everybody, and welcome to my Intermediate Accounting 17th edition video solution walkthrough for Kiso, Weingen, and Warfield. This is exercise 1424. This is the textbook, the Intermediate Accounting 17th edition textbook. Authors are Don Kiso, Jerry Weingant, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons, Wiley. All rights reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley. Okay. So when we go through over here, so we've got exercise 1424, and this kind of relates back to what we did earlier with exercise 1422 and 23. Now, the thing over here is we know it's going to be a gain because that's what Kiso says. But as we go through over here and look at this, what we're now going to go through and do is say, can Barclay Company record a gain under this term modification? So the way we look at this is my carrying value of my note payable is $3 million. Now, the magic here is that the amount of any type of, we would record a gain if the future cash flows undiscounted are essentially less than the carrying value of that note payable. So over here is we've got the amount of the principal is going down to 1.9 million. Now, in terms of the interest payments, if we go back over here and look, it tells us that the bank agrees to restructure 12% and reducing it to 10%. So over here, my principal, my interest payments are going to be, and this is going to be 1/1/24. My interest payments on 12/31/21, 12/31/22, and 12/31/23 are all going to be 10% of this amount right over here. So my interest payments are going to be 10% of my new reduced principal amount, which is 1.9 million. And over here, since I have my total amount of future cash flows is 2,470,000, I can go ahead and recognize a gain on extinguishment of indebtedness. And just to also kind of be mindful of this, there are also tax ramifications. If you receive relief from indebtedness, the bank can issue you, I think it's a 1099 OID, but just be mindful of the fact that you could have other kind of challenges coming along with getting this reduction in indebtedness. So what we're going to have over here is we're going to debit notes payable for how much? Well, our carrying value of our notes payable was 3 million. Our future cash payments are going to be 2,470,000. So my gain on restructuring on debt is going to be 530. So over here, I'm going to debit gain on debt. I'm going to debit notes payable. I'm going to credit gain on debt restructuring for the same dollar amount. And this is going to be on 12/31/20. Okay, so instead of record gain on debt restructuring. So again, the undiscounted cash flows, and this is a very common test when we were looking at asset impairments. We were also doing something kind of similar. Is the asset impaired? We're comparing the future cash flows or the future net cash flows to the value of the asset to determine whether or not we have impairment. So this is kind of looking at the same way. So over here, so prepare the journal entries to record the gain on Barclay's books. We've done that. What interest rate should Barclay use to compute its interest expense? Will it be the same? Okay. So essentially, and this is the answer that we're being given, is that because, and I'm reading this from their solution, because the new carrying value of the note equals the sum of the undiscounted future cash flows, the imputed interest rate is 0. So because actually that kind of makes sense. Since the new carrying value of the note is, we're going to write this off directly, we're debiting notes payable. So since my note payable account since my notes payable over here at 3 million, and once I write this off by 530 over here, my carrying value of my note payable is going to be 2,470,000, which is the same amount as my future cash payments. Therefore, it's going to be 0 interest expense. So what's going to happen is on 12/31/21 through 12/31/23, so at the end of each year, I'm going to debit notes payable for 190, and I'm going to credit cash for 190. Okay, then over here, when I come down to 1/1/24, I'm going to go ahead and debit notes payable for 1.9 million. And I'm going to credit cash for the same dollar amount. So that's kind of what happens when we have, this situation over here. So this is relatively, do we have to do an interest payment schedule? There's no interest expense. So basically every time we make a payment, it's essentially going to be reducing the carrying amount of the note payable. What entry should they be making in, what should they be making in 2024? That's going to be right over here. And let's take a look. Prepare the interest payment schedules for Barclay payment and maturity. So yeah, so this is kind of what's happening. So yeah, that's exercise 1424. So again, if we have a gain, because we're writing down that note payable down to its new value, which is going to equal the future cash flow payments, there's no interest, and there you go. So thank you for joining me here today. I look forward to seeing you on the next video. Have a great one.